OpenAI is currently valued at roughly $300 billion on paper, and a group of state attorneys general just opened an investigation into the company. Here is what the financial press is missing. This is not about fines. The actual risk is that regulatory action rewrites the structural terms under which a future public offering is even possible. The question every serious investor holding private AI exposure needs to answer right now is not whether OpenAI did something wrong. It is whether this investigation creates a valuation ceiling that the market has not yet discounted. That answer is more complicated and more consequential than anything you will read in the initial coverage. Let us be precise about what is happening, because precision is what separates useful analysis from noise. The New York Times reported that multiple state attorneys general are investigating OpenAI. The specific legal framing has not been fully disclosed, but based on the pattern of prior state-level tech investigations, there are two plausible theories worth taking seriously. The first is a charitable solicitation or public benefit theory. OpenAI was originally incorporated as a nonprofit. Its subsequent conversion to a capped profit structure, and now its push toward full for-profit status, creates a genuine legal tension around whether assets that were donated or granted for public benefit are being redirected toward private enrichment. Several state AGs have jurisdiction over nonprofit conversions, and New York's AG in particular has broad authority in this area. The second theory is an unfair business practices or consumer protection angle, which is more familiar territory, but also more politically legible. Easier to pursue, easier to explain to a jury. What makes the first theory dangerous for valuation is that it does not target conduct. It targets the corporate structure itself. If an AG successfully argues that OpenAI's conversion from nonprofit to for-profit was improper, the remedy is not a fine. The remedy could be forced restructuring, asset clawback, or restrictions on equity distribution. None of that shows up in a quarterly earnings miss. It shows up in the terms of a prospectus or in an IPO that simply never happens. This is not financial advice, but any model that treats the OpenAI valuation as a clean path to public liquidity without this risk factored in is an incomplete model. The OpenAI investigation did not arrive in a vacuum. Earlier in 2026, the Anthropic-Fable situation gave us the first visible case study of how regulatory pressure in the AI sector actually resolves. And the pattern is not reassuring for anyone modeling clean outcomes. Axios reported that the deal faced intervention from both Amazon and the White House. Sit with that for a moment. You had a corporate transaction involving a leading AI lab that drew federal executive attention and intervention from one of the largest corporate stakeholders in the space. That is not a normal regulatory environment. That is a political economy where AI deals are being evaluated through a lens that combines antitrust, national security, and direct corporate lobbying in real time. The practical implication for anyone holding private AI equity is this. The traditional venture playbook assumes that regulatory risk is either negligible at the private stage or resolves cleanly before an IPO. What the Fable situation demonstrated is that regulatory intervention can happen mid-transaction, can involve actors with competing interests, government, strategic investors, and the company itself, and can produce outcomes that are not predictable using standard deal analysis. For the OpenAI situation specifically, Amazon is a meaningful stakeholder in the AI infrastructure ecosystem. Microsoft remains deeply embedded in OpenAI's capital structure. If an AG investigation escalates into a formal enforcement action, the number of parties with economic exposure, and therefore the number of parties applying pressure on the resolution, is not small. That complexity does not mean OpenAI fails. It means the probability distribution of outcomes is wider than a $300 billion single-point valuation implies. Wide distributions are the enemy of venture math. Here is the mechanism that most coverage skips over entirely. Private AI valuations are not just about revenue multiples. They are about the credibility of a liquidity path. When institutional limited partners, pension funds, endowments, large family offices, commit capital to a fund that holds private AI exposure, they are implicitly betting that there is a functional path to liquidity within a defined time horizon. That path is almost always either a strategic acquisition or a public offering. Regulatory investigation directly attacks both legs of that thesis. On the acquisition side, if the corporate structure is legally contested, any acquirer takes on the liability of that contest. That is a negotiating lever that suppresses acquisition premiums or eliminates strategic bidders who cannot absorb the headline risk. On the IPO side, a material government investigation is a required disclosure in any S-1 filing. That disclosure does not kill an IPO. Plenty of companies have gone public under investigation. But it forces the company to price the risk into the offering, which means either a lower valuation or a more dilutive structure for existing cap table holders. The investors most exposed here are not the Series A or B holders. Those positions were priced at valuations where even a significantly impaired exit still returns capital. The exposure sits with late-stage investors who bought in at $80 billion, $150 billion, or $200 billion valuations on the assumption that a public exit would unlock further appreciation. At those entry prices, the margin for error is narrow. A regulatory-driven valuation compression of even 30 to 40% at IPO does not just reduce returns. It can flip late-stage positions from profitable to break-even or worse. What should intelligent observers be watching? 3 things. First, whether other state AGs join the investigation. Multi-state coordination signals serious intent, not posturing. Second, whether OpenAI accelerates or decelerates its for-profit conversion timeline in response. Speed would signal they believe resolution is achievable. Delay would signal otherwise. Third, watch secondary market prices for OpenAI shares on private trading platforms. Those prices will reprice before any public statement does. Secondary market movement is where informed capital speaks before the press conference. We opened by asking whether this investigation creates a valuation ceiling the market has not discounted. The answer is yes. Specifically for late-stage cap table holders who need a clean IPO to realize returns. The broader question this raises is one we are going to address directly in the next video. If private AI valuations are structurally mispriced, where does that leave the publicly traded companies with the deepest AI infrastructure exposure? If you want that analysis when it drops, subscribe. This channel does not repeat what Bloomberg already told you.